You could owe $1,000 just for a simple mistake. Tax myths are more common than most people think. Many Americans hold firmly to tax ideas that are simply not true, leading to potential penalties and missed opportunities. One big myth is believing that filing an extension increases your audit risk. This is false. Filing an extension merely gives you an additional 6 months to file your paperwork, but it does not change your audit probability. The Internal Revenue Service actually processed 164 million individual income tax returns in 2022 alone. Less than 1% of these returns were audited. For taxpayers earning under $200,000, only 0.2% faced an audit. Even for those with incomes over $10 million, the audit rate was only 5.8%. Extensions are common, with millions filing them each year without any extra audit scrutiny. Another widely held belief is that if you file an extension, you also get more time to pay your taxes. This is also incorrect. An extension gives you more time to file your return, but your tax payment due date remains April 15th. If you owe money and do not pay by the deadline, you will incur penalties and interest. The penalty for failing to pay is 0.5% of the unpaid taxes for each month, or part of a month the taxes remain unpaid. This penalty can reach a maximum of 25%. Interest also accrues on underpayments, currently at 7% annually compounded daily. Imagine paying hundreds of dollars extra simply because you misunderstood an extension. Many people also assume that a tax refund means the government is giving them free money. This is perhaps one of the most misunderstood aspects of taxes. A tax refund is not a gift. It is your own money that you overpaid to the government throughout the year. When you receive a refund, it means you had too much withheld from your paychecks, or you made too many estimated tax payments. While a refund can feel nice, it essentially means you gave the government an interest-free loan for 12 months. It is often more financially savvy to adjust your withholdings to receive more money in each paycheck, rather than waiting for a large refund at year end. This way, your money is working for you, not sitting with the government. There is also a persistent myth that the IRS will contact you first by phone or email about a tax issue. This is extremely unlikely and often a sign of a scam. The IRS almost always initiates contact through regular postal mail. They will send official letters or notices to your last known address. If you receive an unexpected phone call or email demanding immediate payment or personal information, it is almost certainly a fraudulent attempt to steal your identity or money. In 2023, the IRS highlighted a significant increase in phishing scams and phone cons targeting taxpayers. Be extremely cautious and verify any communication directly with the IRS using their official phone numbers or website. Never give personal financial details over the phone to unverified callers. Some individuals believe that if they make little income, they do not need to file a tax return at all. This is not always true. Even if your income falls below the standard deduction amount, you might still need to file to claim certain refundable tax credits. For instance, the Earned Income Tax Credit, or the Child Tax Credit, can put money back in your pocket even if you had zero tax liability. In 2023, the standard deduction for a single filer was $13,850. For married couples filing jointly, it was $27,700. However, if you had net earnings from self-employment of $400 or more, you must file a return regardless of your total income to pay self-employment taxes. These taxes cover your Social Security and Medicare contributions. Another common misconception centers on tax deductions for charitable contributions. Many believe they can deduct any donation they make to charity, while generosity is commendable. There are specific rules. You can generally only deduct cash contributions or the fair market value of property donated to qualified organizations. For cash donations, you need a record of the contribution, such as a bank statement or a written acknowledgement from the charity for donations of $250 or more. Non-cash donations also require detailed records, and for items valued over $5,000, an appraisal is often necessary. You also need to itemize your deductions to claim charitable contributions, which only about 13% of taxpayers do, since the standard deduction is often higher. The fear of an audit leads to many myths. One is that you should never amend a tax return because it flags you for an audit. Filing an amended return form 1040X is perfectly acceptable if you discover an error or omitted information on a previously filed return. The IRS understands that mistakes happen. While an amended return might receive closer scrutiny, it does not automatically trigger an audit. It is far better to correct errors proactively than to leave incorrect information on file, which could lead to bigger problems later. The statute of limitations for the IRS to audit a return is generally 3 years from the date you filed the original return, or the due date of the return, whichever is later. However, if you omit more than 25% of your gross income, this period extends to 6 years. Many people think that all gambling winnings are tax-free, especially if they are small amounts. This is false. All gambling winnings are considered taxable income by the IRS, regardless of the amount. This includes winnings from lotteries, raffles, horse races, casinos, poker, and even fantasy sports. For winnings over $600, or if the payout is at least 300 times the amount of the wager, the payer will generally issue you a Form W-2G. However, even smaller winnings that do not trigger a W-2G must still be reported on your tax return. You can deduct gambling losses, but only up to the amount of your winnings, and you must itemize to do so. Keeping a detailed log of your winnings and losses is crucial. There is also a myth that if you barter services or goods, you do not have to report the value as income. This is completely incorrect. The fair market value of goods or services received through bartering is taxable income. For example, if you are an accountant who prepares a tax return for a plumber in exchange for plumbing work, the value of that plumbing work is taxable income to you, and the value of your accounting service is taxable income to the plumber. This is sometimes called a cashless transaction, but it is still taxable. In 2023, many online platforms facilitate bartering, and these platforms are now required to report transactions to the IRS if they meet certain thresholds. Some taxpayers mistakenly believe that only income from a W-2 job is subject to taxes. This is a significant misunderstanding. Income comes in many forms, and most of it is taxable. This includes independent contractor income, interest income, dividends, capital gains, rental income, royalty income, and even severance pay. If you receive a Form 1099 from an employer or client, it indicates you are an independent contractor and you are responsible for paying self-employment taxes on that income. This includes Social Security and Medicare contributions, usually paid by an employer for W-2 employees. It is vital to report all sources of income to avoid issues with the IRS. A very common myth among new homeowners is that all home improvements are immediately tax deductible. This is also not true. Most home improvements are not immediately deductible. Instead, they add to your home's cost basis. This increased cost basis can reduce your capital gains tax when you eventually sell your home. For example, if you buy a house for $300,000 and spend $50,000 on a major renovation, your cost basis becomes $350,000. If you sell the house for $500,000, your taxable gain is $150,000 rather than $200,000. Some energy-efficient home improvements can qualify for tax credits, but these are specific and not all improvements apply. Many fear that the IRS is constantly monitoring their bank accounts for large deposits. While the IRS does have mechanisms to detect unusual financial activity and transactions over $10,000 are reported by banks via a currency transaction report, this does not mean they are directly watching every single deposit. Their focus is typically on unexplained wealth or large sums of money that do not correlate with reported income. The Bank Secrecy Act requires financial institutions to report cash transactions over $10,000. This is a measure to prevent money laundering and other illicit activities, not to automatically audit every person with a substantial bank balance. As long as your deposits come from legitimate reported income, you should not have concerns. The belief that owning a business automatically provides huge tax write-offs is another widespread myth. While businesses do have many legitimate deductions, they must be ordinary and necessary expenses directly related to the business. Not every personal expense can be magically transformed into a business deduction. For instance, a business owner cannot deduct their personal groceries or clothing unless the clothing is a required uniform not suitable for everyday wear. The IRS scrutinizes business deductions, especially for small businesses and sole proprietorships. Keeping meticulous records and understanding what truly qualifies as a business expense is paramount to avoid problems. Some taxpayers believe that if they use tax software, the software will catch every possible deduction and minimize their tax liability perfectly. While tax software is a powerful tool, it relies heavily on the information you input. It cannot know about every unique deduction or credit you might qualify for if you do not provide the correct details. It is still the taxpayer's responsibility to understand their financial situation and correctly identify all relevant income and expenses. Software is an aid, not a replacement for due diligence or professional advice if needed. In 2020, 2 million of Americans used tax software for filing their taxes, and many still missed out on potential savings. The myth that tax season always ends on April 15th causes unnecessary stress. While April 15th is the traditional deadline, it can shift. If April 15th falls on a weekend or a holiday, the deadline is typically moved to the next business day. For example, in 2024, tax day was April 15th. In 2025, it is also April 15th. However, if that day had been a Saturday or Sunday, it would have been shifted. This small detail can provide a little extra breathing room for last-minute filers. Always check the official IRS website for the exact filing deadline each year to avoid confusion. Another common misconception is that if you get married, you must file taxes jointly. Married couples have the option to file jointly or separately. While filing jointly often results in a lower overall tax liability due to various credits and deductions, it is not always the best choice. In some specific situations, such as when one spouse has significant medical expenses, or if one spouse is enrolled in an income-driven student loan repayment plan, filing separately can be more beneficial. It is wise to calculate your taxes both ways to determine which filing status yields the most favorable outcome for your unique financial situation. Do not just assume jointly is always better. Many taxpayers believe that the IRS does not care about small errors on their tax returns. While the IRS is not going to send a SWAT team for a $20 math error, even small inaccuracies can snowball or attract attention if there are many of them. It is always best to be as accurate as possible. Incorrect information can delay your refund or lead to notices from the IRS requiring clarification. The goal is to file a correct return the first time to avoid any back and forth communication. Accuracy is key, even for seemingly minor details, because the IRS processes millions of returns with sophisticated error checking systems. There is a widespread belief that you can avoid taxes by moving to another country. For US citizens and green card holders, this is generally untrue. The United States has a unique tax system called citizen-based taxation. This means that if you are a U.S. citizen or green card holder, you are required to report your worldwide income to the IRS regardless of where you live or earn your money. There are exclusions, like the foreign earned income exclusion, which allows you to exclude up to $120,000 in 2023 if you meet certain criteria, but you still must file a U.S. tax return. Renouncing U.S. citizenship is a complex and costly process if one truly wishes to sever all tax ties. Some people think that receiving an inheritance is always tax-free for the recipient. While many states do not have an inheritance tax, the federal government does impose an estate tax. However, the federal estate tax only applies to very large estates. In 2023, the federal estate tax exclusion amount was $12.92 million per individual. This means that an estate only owes federal estate tax if its value exceeds this amount. For most Americans who inherit money or property, they will not owe federal inheritance tax. State inheritance taxes vary greatly, with some states having them and others not. For instance, Pennsylvania has an inheritance tax that applies to beneficiaries at different rates. One humorous but persistent myth is that you can claim your pet as a dependent. Unfortunately, despite how much joy our furry friends bring, they cannot be claimed as dependents on your tax return. The IRS definition of a qualifying child or qualifying relative for dependency purposes does not include animals. While some animal-related expenses might be deductible in specific business contexts, such as a guard dog for a business or a service animal, most pet care costs are purely personal expenses and offer no tax benefit. This includes food, vet bills, and pet insurance. It is a nice thought, but not a reality for tax purposes. Another myth is that you can always deduct all of your medical expenses. While medical expenses are deductible, you must itemize your deductions to claim them. Furthermore, you can only deduct the amount of medical expenses that exceeds 7.5% of your adjusted gross income. This means if your AGI is $50,000, you can only deduct medical expenses above $3,750. For many people, this threshold is difficult to meet, making the deduction less accessible than commonly believed. Keeping meticulous records of all medical costs is crucial if you hope to claim this deduction. The idea that tax brackets apply to all of your income is also a common misunderstanding. The U.S. tax system uses a progressive tax bracket system. This means different portions of your income are taxed at different rates. For example, in 2023, the first $11,000 of taxable income for a single filer was taxed at 10%. The income between $11,001 and $44,725 was taxed at 12%. Your entire income is not taxed at the highest bracket you fall into. Only the portion of your income that falls within a specific bracket is taxed at that bracket's rate. This is a crucial distinction for understanding your true tax liability. Many believe that tax laws are permanent once established. Tax laws are constantly changing. Congress regularly passes new legislation that impacts tax rates, deductions, and credits. For example, the Tax Cuts and Jobs Act of 2017 significantly altered the tax landscape for individuals and businesses. Every year, the IRS adjusts various tax provisions for inflation, such as standard deduction amounts and tax bracket thresholds. Staying informed about these changes is essential for accurate tax planning and filing. What was true for your taxes last year might not be true this year. The misconception that all tips are untaxed cash is another major myth. Tips are fully taxable income, just like regular wages. Whether you receive tips in cash through a credit card charge or from a tip pool, you are required to report them to your employer. And the IRS, employers are responsible for withholding income, Social Security, and Medicare taxes on reported tips. If you receive $20 or more in tips in a month from any one job, you must report all of your tips for that month to your employer. Failure to report tip income can lead to penalties and interest. This applies to servers, bartenders, and anyone else who regularly receives tips. Finally, some people believe that tax evasion is a victimless crime. This is a dangerous myth. Tax evasion is a serious federal crime with severe penalties, including substantial fines and imprisonment. When individuals or corporations evade taxes, it reduces the government's ability to fund essential public services like infrastructure, education, healthcare, and national defense. It places a greater burden on honest taxpayers who then have to cover the shortfall. The IRS's Criminal Investigation Division works diligently to detect and prosecute tax evasion. In 2023, they investigated thousands of cases, leading to hundreds of convictions and billions of dollars in recommended fines and restitution. Tax myths might seem harmless, but they can lead to real and damaging consequences for individuals and the broader society. Understanding the facts is crucial.